What is capital gains tax? How much is it? And is there any way to avoid paying it? Your investment property magazine editor Sarah Megginson spoke with Ed Chan from Chan and Naylor to uncover everything you need to know about CGT.
If you make any kind of money, you'll get taxed, and the different types of taxes is based on the different kinds of income that you earn. And capital gains tax is a tax that's calculated on any sort of assets, investment assets that you have that's gone up in value, and you've sold it and you've made a capital gain out of it. There is a concession on capital gains, and they allow you a 50% deduction on that capital gain for calculating tax purposes if you've held the investment, and we're talking about property in this instance, for more than 12 months. So if you've held it for more than 12 months and you make a capital gain of $500,000, you don't pay capital gains tax on $500,000, you pay capital gains tax on half of that, which is on $250,000. However, if you had earned income of $500,000, you would pay income tax on the whole lot. So that you can see it's quite a good concession, and it also compensates for the risks that people take to go into these things, because often properties don't always go up in value, and they can come down in value, and if you sold it when it's low in value, you could lose money on it. So there is a risk that's associated with it. So the government, in their wisdom, in order to attract people, to incentivize people to come into this investment, they gave a 50% discount on capital gains tax. It used to be no capital gains tax, and way back, and so this is, whilst it's a great concession, it's still somewhat more than it used to be. Yes, if you're an Australian resident, you have a tax threshold, and the first, and I can't remember what it is this year, but it's up to about 20,000, where you don't pay any tax, and then the tax is calculated beyond that. However, if you're a non-resident, then you don't get that threshold, so it's taxed from the very first dollar. So there are concessions for residents, and again, the capital gains tax rate is based on your personal tax rate, and it's not a fixed amount. And however, if you're a non-resident, it is a fixed amount, but if you're a resident, it's just based on your personal tax rate. So if you're on a 20% tax rate, then you pay the capital gains tax after the 50% discount at 20%. So then if you're on a 47% tax rate, then you pay 47% tax after the 50% discount in your particular circumstances. So so there isn't a rate for capital gains tax as such, unless you're a non-resident. But if you're a resident, it's just based purely on your personal tax rate. No, they don't, and they also don't get access to the threshold. So there is a flat rate of tax for non-residents, and they don't get any of the other benefits that's associated with a resident. Capital gains tax is one of those things that it's very difficult. The only way that you can sort of minimise it is to hold the property, or the investment, in this case the property, in the taxpayer's name who's on a lower rate of tax. The problem is, of course, is that when you initially buy a property, it could be negatively geared, because most good properties that have high growth are negatively geared. And if it is negatively geared, you want it in the person's name who's paying the highest rate of tax, because when you do get a refund back, it's a refund based at the higher rate of tax. And if you'd held that property in the name of the person who's paying low income tax, then the refund will be lower. So naturally, you want it in the person's name who's paying the most amount of tax, because the refund would be at the highest. However, once you come to sell the property, the capital gains tax will be calculated at his tax rate, which then is the higher rate of tax. So it's a bit of a problem in terms of whose name should I put it in. But on balance, it's better to buy it in the taxpayer who has the higher rate of tax, because if you held that property and property is a long-term investment, so you should hold it for 10 years, 20 or 30 or 40 years. And for 20 or 30 or 40 years, you're getting back a higher rate of refund from the tax department, which you can use to buy the next property, or you can use to do things with, and the money's better in your hands for that period of time. The 6-year rule applies to your home, and now homes are called your principal place of residence, and they're generally exempt from any sorts of tax at all, whether it's land tax or capital gains tax or whatever. However, once you rent that property out and you get a tenant, then you've got to pay land tax on it. However, you have to pay capital gains tax on it unless you move back into it within 6 years, hence the 6-year rule. And once you move back into it, then you get rid of the capital gains tax part of it, and you can then move out of it again and rent it out. And as long as you've moved back into it within the next 6 years, then you're exempt from capital gains tax. Okay, the payment of the capital gains tax is payable when you lodge your tax return. For example, if you sold it in January and you then have to lodge a tax return after June, so in that year, your tax year ends in June, and depending on when you individually have to lodge a return, and everybody's different. Some people have to lodge their return by 31st of October, and other people may not have to lodge their tax return till February or March the following year. And the reason why, and to work out when you have to lodge your return, if you ask your accountant, they'll be able to tell you. But the capital gains tax that's due on that property that's sold in January won't need to be paid till after July. So it could be anywhere in October all the way through to May next year. So there's a bit of time.